Welcome to NHMR's Sponsor Spotlight, where each month we highlight one of our sponsors, put a face to the company name, and get their perspective on the current real estate market. We are in a unique market. I've been in this business now almost 20 years. This is unlike anything I've ever seen. And so here we are, we're recording this on April 18th, 2021. I have to say that because it seems like things are changing daily.
Yes.
And I'm curious your take. What are some of the specific challenges as a mortgage mortgage writer in this market?
Yeah, so, I did a lot of new agent training at the board over the last several years. We were running several programs and training programs geared towards new agents. And what I would say to all the new agents at the beginning of every training is, look, we are in a buyer's market. If and when, and the answer is we will flip to a seller's market. You may wish you were never born. And the reason for that is because as exciting as it is for houses to sell quickly, the stress and pressure of having multiple offers, and more importantly, offers over list price, and really having a huge impact on the first-time buyer is I think kind of one of the detriments of this market. First-time buyers oftentimes are on the short end of the stick when it comes to a hot seller's market. We see listing agents who don't want to accept pre-approval letters for FHA clients. We see them not wanting to accept letters, and this really breaks my heart, for veterans with VA loans, down payment assistance programs, renovation loans. So important in Connecticut's real estate market is the use of renovation loans. All of those programs are pretty much sidelined in favor of a straight conventional mortgage, if in fact there's not cash offers. So, the unique market conditions is we really see the first-time home buyer finding it more and more difficult to be able to procure a property, without having to go way over list price.
Exactly. No, we're all seeing that, and it's incredibly competitive. So the market dynamics are what they are, and in a seller's market, the very definition of it is that they're going to have their choice of buyers to choose from. But with all that said, if you could give some advice to buyers or to the realtors listening who are working with perhaps a first-time buyer or someone without a ton of down payment saved, et cetera, what's your advice to try to make that bid most competitive and to try to compete in this market?
Yeah, I think it's trying to any extent possible create assurance with the listing agent, first and foremost, to the point we were discussing before, that the pre-approval letter that's coming in is a well researched, well-documented pre-approval letter. I know I've been asked a number of occasions to call the listing agent and just go through without releasing any financial information, obviously, because we're going to respect our customers' privacy, but to just let the listing agent know that we have checked credit, we've checked assets, we've documented income, we have run the loan through automated underwriting systems, and that this pre-approval letter, you can really consider it as good as cash on the credit and income side. Then secondarily, we deal with, is the property going to appraise out, which brings a whole other kind of like second stage that we're dealing with as we go forward. So it's just really trying to create, I think unfortunately that's about all you can do is try to create comfort. And just, I'm working really hard along with the realtors that I do business with at keeping first-time homebuyers motivated. It's discouraging, and just, letting them know that, market conditions will ease, and it's just a matter of staying in the game and getting up at bat as many times as you can. And eventually they'll be successful.
Yeah. Well, that it's interesting to say market conditions will ease. I mean, eventually everything balances out. But I am curious. I know the old adage, no one has a crystal ball, and yet I always like to ask people to pull out their imaginary crystal ball, stare into it, and tell me what they're seeing. And if you ask enough people, you at least get some sense, of kind of what the ask the audience answer is to this.
Right.
So yeah, if you would share with us as best you can, when do you think, when this might level out? Do you think when it does, we'll continue to see price support, or do you think at some point we kind of overreach? And I'm sure it's tied to rates. So, what are you hearing in terms of the rate environment going forward?
Yes, I've done a lot of analysis actually on these market conditions, and I can tell you, I know you're almost 20 years in the business. We've made mention of the fact I've been doing this for 35. The market that most resembles what we're in right now was the market that was in play in like 1985. Very similar to what we're seeing now. This market in no way, shape, or form is similar to, the housing boom of the 2000s. And I really want to make that point because a lot of times I'll have a first-time buyer say to me, well, I'm going to wait till next year when prices drop. And I'll say to them, why do you think prices are going to drop? And there's a few things that we've got to take into consideration. First of all, we've only really seen one time in history where prices dropped dramatically, and that was after the subprime mortgage crisis. There is no lending. There are no loose lending practices going on in the market today that are creating this artificial increase in housing. The increase in housing, especially in Connecticut, is long overdue. We were the last state in the country to exit the housing crisis from an appreciation standpoint. We've only started seeing appreciating property values in Connecticut late 2019, 2020. I don't believe we're going to see a market correction relative to appreciating values. Now, whether they'll stay as hot as they are right now, no, of course, I don't think they'll stay that hot. But I don't think we're going to see. I don't think we're going to see a real slowdown in appreciating values. The rest of the country was experiencing appreciation booms for 5 years before we came out of it. We're just starting to recapture our equity, and we're still not, in some markets, we're still not back to the pre-subprime crisis levels. I think the latest statistic I saw was only 50% of the towns in Connecticut have reached that level from 2000. So I don't think housing prices are going to come down. Similarly, interest rates, we believe interest rates right now, 30-year fixed rate, it's running about 3.25% with 0 points. We believe that's about where it's going to stay through the end of the year. There's a bit of hysteria in February when rates popped up. Rates went up about 3/8 to 0.5%. But as I remind everybody, they were artificially low because of a pandemic. Interest rates weren't 2.75%. Now we're seeing them in the 3.25% range. I think they'll stay down this low. The Fed is pretty committed to keeping interest rates down, but time will tell on that.
Yeah, I think that's all really interesting. And I think you bring an important perspective to this because I think there is a sense of what goes up must come down. But the underwriting standards still being relatively rigid are going to provide a baseline of support that's much different than 2007. Yeah. And I kind of agree with you that real estate is one of those. It moves slowly in either direction. When the quote unquote bottom fell out in 2008, we didn't really hit a bottom until 2012.
Exactly.
And we kind of scraped it for a while, but it's the same thing going in the other direction. And there's natural restraints such as appraisals and, backward looking comps and a whole host of things. But it's interesting. It's all a matter of sort of how you tune the supply demand dials. And I think that's the other big thing here is on the demand side, do we continue to see some of that pushing out of New York? Is this just a new trend among millennials or not? I'm not sure what the answer to that is. I'm curious anecdotally, are you seeing a lot of people being referred to you that maybe come from different geographies than just a year ago?
Tons of them.
Yeah.
I mean, one of the most common questions, and we have to screen for that when we're pre-approving somebody, right? We want to make sure, do you have permission to work remotely? I mean, we've done loans with people coming in from Georgia, Texas, Florida, California. I did one Sunday for somebody coming in from Florida, relocating, to New Canaan. Lots and lots of people coming in from all sorts of geographies, wanting to get closer to their families, and wanting to flee the cities. A lot of people, just like we've had a lot of people coming from New York, I've seen a lot of people coming down from Boston too. So
sure.
I think finally our geography and location between those two cities really,
with whatever it is, 15 million people just in Metro New York and more beyond that, and we only have 3.5 million people in the state, it doesn't take much of an outflow from New York to kind of impact our own supply demand dynamics.
Yeah, and to my earlier point, let's talk about the Boston market. Boston's has had runaway appreciating values now for at least 5 years.
Yeah.
So people are, with the opportunity to work remotely, if you have an opportunity to move to Connecticut where you can get, again, it's kind of like when we talk about people moving from Connecticut down south, all of a sudden people relocating here from Boston are able to get much bigger homes and much bigger living spaces for, a significant, reduction of what they're paying in Greater Boston.
Exactly. Yes. It looks cheap compared to certain other markets. Well, great. Let me shift gears just briefly while we have you. I do want to hear your thoughts because I know this made the news recently about Fannie Mae cutting back on their second home and investor. And this may speak to some of these people coming out of Boston if they're not relocating, but just buying a second house somewhere. There were some changes to what Fannie Mae will purchase on that market. It did impact rates. Can you give us a brief summary of what that is? And
Sure.
While there might have been a little bit of a knee-jerk reaction, how you think that might settle out and whether it will have a long impact?
So, Fannie Mae and Freddie Mac have kind of sharpened up their approach to their charter, right? Their charter as government-sponsored entities is to provide opportunities for home ownership. Their charter hasn't been to create investment and wealth opportunities for clients through multiple real estate transactions. And certainly as, as investing in real estate has become more and more favorable, what they've seen is a larger and larger percentage of their portfolio growing relative to investment in second homes. What's especially troubling to them right now is what we call the Airbnb phenomenon. And that is this. And I think this is going to be something we're going to definitely want to keep our eyes on. When somebody buys a second home, it's supposed to be a property that's for their personal use. It's not a rental property. And what we're seeing now are people, and again, I run an office in Ludlow, Vermont. So I see, right at Okemo Mountain. So we see this all the time, people buying second homes and immediately putting them on Airbnb for rent during the weekends and the days when they're not going to be there. I think this is troubling to the agencies relative to really what is the intent use of the property. I think that they're seeing a large number of second homes that are really being used as investment properties. And I think part of their decision to pull back on what percentage of this business they'll keep in their portfolios or they'll accept for purchase, I should say, is a direct result of that. We had a case recently at PrimeLending where we did an owner-occupied property, and we were getting ready to sell the loan, and the investor we were selling it to just happened to do a Google search, and the property was already listed for rent on Airbnb. That was on an owner-occupied property. Mm-hmm. So I think there's going to be some evolution in how we classify these properties. Mm-hmm. The knee-jerk reaction when and by the way, Fannie and Freddie came out and made that announcement with no advance warning. Yeah. So lenders who had more than 7% of the loans in their portfolio, knee-jerk reaction was rates went up to stem the flow because all of a sudden there's nowhere to put these loans, mm-hmm. right? And PrimeLending saw that as well. At the time, I believe our percentage was 10%, and we worked hard to try to pull back on that because we didn't want to be stuck with loans. I think the opportunity will happen. I think the private market will emerge. I think private capital investment companies and whatnot will start to fill that void. But certainly, I think the shift has happened. I think you'll see a varying degree of interest rates as different lenders kind of get their arms around what this really means. Mm-hmm. But I definitely think this is a shift that's happened within the industry.
Interesting. And just to clarify for our listeners, when you say 10%, you mean 10% of the loans you were doing were for second home. The rates went probably from something comparable to what you're seeing for first home or up what, a full percentage point or something like that?
Yeah, we saw, In general.
They're settling back down, or is it still about a percentage?
I think you're going to see that done by investor as they try to level off their portfolios. I see. So I think it's going to range depending on if you've got somebody who wasn't doing a lot, a lender who wasn't doing a lot of investment or second homes, maybe their rates didn't change that much. But for those of us that were doing a lot of them, and we were, we've got to kind of just give it some time to kind of flatten out into the levels that we need them to be.
Yeah. Interesting. Well, listen, I learned a lot today. I hope some of our Realtor members also did. And so I just want to close out and thank you again for being our premier sponsor at NHMR. Thanks for taking some time to share your market knowledge with us, and really appreciate spending some time with you. It was fun.
Thanks, Jed. It was fun. It was real fun. We'll have to go for pizza soon.
That sounds good. Modern it is.